Stocks sold off here today with the S&P 500 being down 0.42%. And while that wasn't a huge sell-off, keep in mind that we've actually sold off now for 4 days in a row and 6 out of the last 7 trading sessions. None of them have been very aggressive sell-offs, but nonetheless it has been a little bit more persistent here all of a sudden. Now, given where we're standing with the S&P 500 right at a known resistance area, maybe we shouldn't be surprised by that. Keep in mind tomorrow has the potential for volatility as a result of an inflation reading. Who knows, maybe we get an opportunity to break through that resistance at that time. So we'll take a look at all of that, see what it means for our posture. We'll also take a look at some various sectors that are out there. Today, the semiconductors from an industry perspective really put a cold, wet blanket on the technology sector, but we did have some positive movements out of the energy area. So we'll see what that means for their postures as well. Then we'll get into our trade application example where I wanted to feature a bear call spread on a well-known cable company that seems to be falling down and away from its 30-day moving average. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's August 9th, 2022. First of all, if you're new, welcome aboard. Remember to go over to YouTube, click subscribe on our channel, then go down below into the description area. Make sure you're signed up for our email distribution list so that way you can be notified whenever we post these videos. In addition to that, we're heavy users of Twitter, and if you're not doing so already, I would encourage you to follow me at Brandon Van Zee. We really appreciate those of you that click like and retweet on these Market Outlook related posts. And then last but not least, we do have a presence on Facebook. Feel free to join our group at that web address you see in the logo in front of you. All right, let's go ahead and jump into today's trade activity. And we've got our S&P 500 heat map pulled up here in front of us. And as you can see, it was a little bit more of a bearish day here today. It wasn't aggressively bearish, but we certainly had a few more red squares and rectangles showing up here today. You can see that some of the areas that were hardest hit from a consistency perspective, you could probably say technology would be thrown into that discussion. You did have Microsoft close a little bit higher and Apple was basically flat, but other than those two big giants, most of the other tech stocks, especially the semiconductor names, were hit pretty hard here today. Remember that today they actually were signing the CHIPS bill here in the United States, and so perhaps it was a situation where it was buy the rumor, sell the news, because it sure didn't seem like the semiconductor companies responded too well to that information so far. Who knows? Maybe it'll be a delayed response. But today was a pretty ugly day for a lot of those semiconductor companies. I do think that Micron came out with its own negative individual news in addition to what's been going on there with the industry as a whole. So Micron was down about 4% here today as well. Communication services largely closed in the red today. You can see Alphabet, one of the bigger squares there. Late in the day, Alphabet was receiving notification that they were likely going to be sued for monopolies here in the United States, and we could hear more details about that as soon as maybe a month or so from now. The stock really did handle things quite well in regards to that news. The market was open when it hit, and the stock did go down a little bit after the news came out, but as you can see, we did still settle down by less than 1% today. So you would think that if the market wasn't already considering that possibility, that Google would have been down dramatically more if it would have come out of left field. So perhaps it was widely expected that this information was going to come out. You also saw a number of the media plays struggling. Disney was down the day before they report earnings tomorrow. We did have WBD, that's the new Warner Bros. Discovery spinoff from the old AT&T. It was down another 6.5% today. That stock has not had a good start as a publicly traded company. Then we see a number of those video game companies down here today as well. And then some of the cable companies were down today, and we'll actually have a little bit more to say about that in tonight's trade application example. We also had consumer discretionary struggling here today. Amazon was down over 1%, which I'm happy about for this presentation's purposes. Some of you will know that we have a bear call spread going on Amazon at this moment in time, and it didn't exactly start out the way that I wanted it to, because the very next day after I did the trade, the stock went up pretty nicely. But we're kind of correcting that a little bit here. The last couple days it's been down, so we're actually doing just fine on that trade as it stands here in real time. So Amazon was down, Tesla was down about 2% today. You saw some of those other auto manufacturers like Ford and GM both down pretty substantially. A couple of the big home improvement stores, Home Depot, Lowe's, both struggled today, down 2% and 3% respectively. And a number of those apparel-related names, Nike was down, VF Corp was down, Ralph Lauren was down. So a number of those players, as we get geared up for back to school, maybe there's a little bit too much supply out there as it stands right now. Now onto the more positive side of the equation. And of course, we did have some areas that held up a little bit better today. And I would say healthcare was amongst the areas that held up a little bit better. Now keep in mind, healthcare is a pretty sprawling sector compared to some of the other sectors out there. So it wasn't necessarily a clean sweep or anything like that. And I would also say that the areas that did manage to hold up pretty well are kind of the more defensive types of areas there in healthcare as well. Remember earlier this year, we saw days where Merck and Bristol-Myers Squibb were doing really well while the rest of the stock market was just getting annihilated to the downside. So I'm not sure if that's something that we want to cheer on when we see a day where those two were kind of leading the way once again. Nonetheless, that is what played out here today. One biotech stock that has repeatedly caught my eye as is Vertex Pharmaceuticals, VRTX. That stock did hit, I believe, a new 52-week high here today, so that was one of the exceptions there within the biotech space that managed to do pretty well as a more speculative play. They've got a little bit of CRISPR exposure there as well with their partnership with CRISPR Therapeutics, so that's an area of interest of mine as well. In addition to healthcare, I would say that we had financials seemingly holding up a bit better here today. Remember, financials really have not been a superstar standout in 2022. Even after the recovery started at the beginning of July, a lot of the financials kind of took a back seat to a number of the other sectors. But it does seem like today they found a little bit of their mojo. And most of those areas, including the big banks, the broker-dealers, the asset management companies, even Berkshire Hathaway and some of those insurance companies, they all managed to close in the green here today. So it was a pretty strong day there for the financials. We had good strength out of the utilities here today. Most of those ended up in the green. I would say more than half of the real estate area ended up in the green. Staples were a little bit more of a mixed bag. I'd say it's kind of more of a coin flip there, where you had Walmart doing well. I heard some interesting news about Walmart possibly getting into the video streaming business after hours here tonight to compete against Amazon Prime. That's just what the world needs, right? Another video streamer. Of course, I'm being sarcastic there because it seems like we've got too many as is. But who knows? Maybe Walmart will throw their hat into the ring there. But that was kind of offset by the weakness in something like Procter & Gamble. So a little bit of a mixed bag there in the consumer staples. And then I would say that today's more consistent winner was probably energy. If we were to right-click and then go to just to expand the energy all by itself here within the S&P 500, you can see that there was only one energy stock that closed in the red today. That was Baker Hughes. Otherwise, all the other major energy companies did close nicely in the green here today. And, they've kind of been back and forth. We'll talk about that a little bit later here when we get into the sector selector as well. But, we're trying to find our footing there with energy to see which direction it wants to go. I did hear that Warren Buffett was buying more Occidental Petroleum and now owns, I want to say it's like 20% of the company. And he's been a persistent buyer of that particular stock here this year, which is somewhat out of character for him in the way he usually goes to work. Many of you know I'm a big Warren Buffett fan, having gone back to the Berkshire Hathaway annual shareholders meeting for, I think it's like 16 years now. Only 2 years that I missed in the last 18 were the two COVID-related years where they didn't allow guests to attend. But I try to keep track of Buffett's movements and how he kind of approaches the world. Not that he's perfect, because he makes plenty of mistakes as well. But I do think he is a good person to learn from and to kind of gain insight from. And what I would say is that his behavior in Occidental is quite peculiar compared to the way he handles most of his investments. In fact, some of you saw me tweeting about his buyback program at Berkshire Hathaway over the weekend, and I said this is how buyback programs should be operated. And my point of that tweet was, you'll notice in the history of how much money they've spent on Berkshire Hathaway stock that they spent the most amount of money on Berkshire Hathaway stock in the quarters where its price was down significantly, like back in 2020. And in the most recent quarter, where the market, and Berkshire Hathaway itself has outperformed the market, they've been buying back fewer shares, and I really wish more companies would kind of implement that. But it kind of speaks to Buffett's general mindset, which is he wants to buy more when something is cheaper, typically. And that's what makes this Occidental situation so interesting, is that he's been a willing buyer of Occidental all year long, even though the price has continually marched higher. So it was up another 4% today in response to that news. Let's go ahead and take a look at our breadth measures now. And as we come over here to the visualize area of the Market Watch tab on the main part of the platform, you'll see that I've got the S&P 500 watch list pulled up here. And today we had about 217 stocks close in the green, 285 closing in the red. So a little bit of a tilt towards the bears here today from that regard, but it was pretty split when it was all said and done. I think the end results of the S&P 500 being down 0.4% today is largely because of what I was mentioning on the heat map regarding technology. Remember, technology kind of hits above its weight class because it is not only a deep and wide sector. There are tons and tons of technology companies, but you have some of the largest market caps within the technology sector as well. So on a day like today, where you basically saw almost all of the semiconductor companies down, many of them are $100 billion companies, that's going to have a bigger end result on the S&P 500 than if something like electric utilities were down or something like that. So today it was more of a split decision than what the end result would suggest. But that's largely because some of the most important companies out there, including those tech companies I mentioned before, and stocks like Amazon and Tesla, struggled here today. So it was a bit more of a risk-off type of a feel to the market today, where you saw a few more of those defensive areas holding up a bit better, and some of the more speculative areas struggling on the whole. All right, let's go ahead and now pop on over here to our charts. And let's take a look at our foregrid and see where things stand from a posture perspective using the Market Forecast Technical Indicator. This is chart 4B for those of you that are premium members of Market Scholars following along at home. And a reminder that the background colors of the chart will tell you whether we have a bullish or bearish posture here currently. And as you can see, we've got this dark shade of green behind all four of our charts right now. And so that tells us we do continue to have a strongly bullish posture using the intermediate line on the Market Forecast Technical Indicator. In fact, those green lines, that intermediate line down below, is in the upper reversal zone on all four of those still. So a lot of them are falling, but remember, we kind of use the upper reversal zone and the lower reversal zone with a little bit of a grace period, so to speak, where you give it a bit of wiggle room, and as long as it's in the upper reversal zone, we consider it strongly bullish, and if it's in the lower reversal zone, we consider it strongly bearish, and then when it emerges out of those two areas is when the posture would then shift. So right now, there has been maybe a little bit more strain on the markets than there were, let's say, 2 or 3 weeks ago, when we were just getting that big rally started there in July, because you can see that these green lines are mostly falling. The Dow is actually rising, but these other ones, all three of the other ones, do have a falling green line still in that upper reversal zone. The Dow actually has a slightly rising green line there, so maybe it's kind of withstanding the pressures here a little bit better at this moment in time. But one thing that really stands out to me is the fact that while the S&P 500 was down 0.42% today, this was the fourth day in a row that the market sold off. Not only that, but it was the sixth day out of the last 7 trading days that the market closed lower. Yet when you look at this chart, it looks like a nothing burger, a non-event. We've basically just gone sideways. So although we've closed just a touch lower on many of the days, with the only exception being that day right there on August 3rd, we had a big up move on that day, but all the other days surrounding it, those are red candles. And most of them didn't amount to much. They were just barely below break even for the day. But it is kind of weird to see that, hey, the bears haven't gone away. They've been trying to win back the market, but they just haven't been able to make a really good effort. And the bulls have, continued confidence at this moment in time. Now we have to remind ourselves that that can change on a moment's notice, and economic reports and earnings reports and things like that help shape the mindset and the psychology and the sentiment of Wall Street. And tomorrow is going to be one of those bigger types of days. I know you probably hear that a lot, but tomorrow is the CPI reading, or one of the inflation readings. And of course, right now in this current era, inflation is a more hot button issue than it has been in several years. Really, since dating back to the early 1980s was the last time we saw inflation as hot as it has been in 2022. So it remains a lingering concern on Wall Street, and it has the potential to crimp profits. It also has the potential to sway Jerome Powell and company as to what the interest rate policy may be. If inflation remains extremely hot, there's a better than not chance that Jerome Powell will continue the pathway that he set course on earlier this year with more aggressive interest rate hikes to kind of basically try to squash inflation before it gets out of control. So we're all going to be weighting that number tomorrow, and we'll see if it's going to be a big one or not. Remember that right now, with the posture being bullish, we shouldn't be completely surprised if it's just going to be accepted with reasonable open arms, I guess you would say, all else being equal. And we're so far above the moving averages. I think the other good thing the market has going in its favor right now is that even if we do get a sell-off off of the report tomorrow, chances are very high that the markets are not going to come down to the rising 30-day moving average in the short term. Now, could it happen over a week or two? Yes, of course it could. But is it going to gap down tomorrow based off of that number? Highly unlikely. And therefore, even if there is a little bit of lessened enthusiasm after tomorrow's report, I don't think it necessarily has to be the death knell of this market rally that we've seen established since July. Now, on the flip side of that, one thing I don't really appreciate is the fact that where we are at right now with most of these indices is at an important juncture on the charts themselves. We talked about this, of course, last time I did the video as well, and I'm sure most of you have picked up on it as well. But you'll notice that where we have basically been going sideways for the last week and a half in the S&P 500 is nearly identical to where we went sideways on the S&P 500 back here in late May into early June. Now, that was followed with quite an aggressive move lower, so I hope that is not going to be on repeat here. But it is not a huge surprise that where the bulls and the bears have fought and waged quite an aggressive war against one another that's been pretty equally fought is exactly at that area where you would expect that to occur, where there was prior resistance. So I guess from that perspective, you probably say, well, the bears are a little bit in better shape because we saw what happened the last time we went up to those levels. But obviously, you're always considering multiple pieces of data. That's just one consideration there. So all in all, I would say we're holding in there reasonably well. and better than I would have anticipated personally, and I'm thankful for that. So as somebody who is along the stock market, as a longer-term investor, I would always appreciate it if the stock market could go up, knowing, of course, that that won't always be the case, and I'll have to deal with the consequences when the market decides not to do that. But right now, I must say that it feels quite a bit better being involved in the market today than it did just a month and a half ago. So we'll take what we can get from that perspective. Now you'll notice that not only do we have a green background on all four of these charts, but we also have a green 30-day moving average in all four of those charts. And what that signifies is price remains above a rising 30-day moving average, and that is a more bullish feature to the markets as well. Remember, for much of 2022, it was the opposite, where we had a red moving average, where price was below a falling moving average. So this has been the most consistent amount of time that we've had in this full calendar year where we've had a green moving average. And so I think the bulls can put that one in their camp, as well as maybe being the opportunity to support this market in its efforts to advance moving forward as we head towards year end. The other thing that I would mention is that we do have what's known as bullish intermediate confirmation signals that exist on all four of our charts here today as well. A reminder of what that particular signal is looking at or requires is just two things, and they involve the green line or the intermediate line and the red line or the momentum line. The green line simply has to be considered bullish. Now you'll notice that on all four of our charts, the green line's in the upper reversal zone, so it is automatically considered bullish. But remember, the green line could also be just going up between 20 and 80, kind of like it was doing back here on the S&P 500 back in July. So that would be another way, just for future reference, not that it affects us today, but just so you guys know educationally what to expect when that happens in the future. So that's the first thing that we need out of a bullish intermediate confirmation signal, is that the intermediate line has to be bullish. That makes sense. Remember what the signal is called, bullish intermediate confirmation signal. And the second part of that signal does require the red line to be in the lower reversal zone, so below 20 on the market forecast technical indicator. And as you can see, that is the case on all four of our charts here today. So we do have bullish intermediate confirmation signals across the board. However, remember, there are ways to try to determine whether signals are better or worse. And generally what we teach to is the idea that you'd like to have the blue line somewhere between 20 and 50, and you do have that in a couple of the cases here today. The S&P 500's blue line is at 30 right now, and the NASDAQ Composite's blue line is at 24 right now. So in both of those cases, that's a more idealized form of the signal. The Dow Jones and the Russell 2000 have not yet had that type of a sell-off quite yet to push that blue line below the 50th percentile. So maybe on those two, it's not quite as good of a trade setup. And you'll notice that the red lines on all four of our charts are above the 5th percentile. Remember, sometimes when the red line is too far down into the low reversal zone, that can portend bad things moving forward. So that's the other good piece of information regarding this signal right now, is that none of the four red lines are below 5. So they're basically all somewhere between 20 and 5 on a percentile basis. And so that's where we like to see it. So, kind of an interesting, opportunity there for people that are waiting to kind of buy the dip. Now, again, we don't want to take that concept too far, I should say, because the truth of the matter is we haven't had a huge sell-off to produce a buy the dips moment. But we have, as I mentioned before, been selling off. This is the 6th out of the last 7 trading days for the S&P 500 to the downside. And so that signal is kind of picking up upon that and saying, hey, if you're waiting for some sort of a pullback, this is about as good as it's going to get for the moment. And therefore, some folks might try to take advantage of that by buying stocks back to the upside. Now, again, that's not interpreting what the market is going to do tomorrow in regards to the inflation reading, but from a technical basis, that's kind of the mindset behind that signal. All right, let's also review real quick the end results here of all four of these indices. I mentioned before, S&P 500 was down 0.42% today. The Dow Jones was today's leader. It was barely down today. It was only down 0.18% today. The Nasdaq Composite was down 1.19% today, so a little bit more of an aggressive sell-off there. And remember, that should make sense given what we saw with Amazon and Tesla and those big semiconductor companies. And then we've got the Russell 2000 actually doing the worst today. It was down 1.46% today. However, the Russell had been the strongest indice out there. And so just be aware that today was maybe just giving back some of those gains. Really, we're just back to where we were 2 days ago with today's sell-off, even though it was above average. Part of the reason it was above average is because the recovery of the Russell 2000 was much more vibrant to the upside, and therefore there's more to give back from that perspective. You'll notice that the intermediate reading on the Russell 2000 is 94 right now, which is the highest out of all four of these, and that's after it was the worst performer today. So I wouldn't read too much into that. I think the trend on Russell 2000 is still pretty solid, and you'll notice that it more easily broke through its resistance than what we saw on the S&P 500 and on the Dow Jones. You'll notice that yesterday we were pretty easily up and over this prior resistance area from early June. So I think that's in the favor of the small cap index there as well. All right, let's go ahead and pop on over here to the internet briefly. I always like to get a chance to say thank you to those of you who support these videos. I know many of you make a habit of doing that each time, and we really do appreciate that. As I always say, as long as you guys are willing to support these free videos, we're willing to keep on doing them. But you know, in order to get the more full-length video, I'd like to see 100 likes or more. And you guys came through for me last time around. 106 of you clicked like for me there. This is directly on Twitter here, but remember, you can also access the tweet in question on the website, on the Market Scholars website, while you're watching the video. You can also find the tweet in question in the email that we send you with the Twitter icon itself in the email. And then also, for those of you watching directly on YouTube itself, in the description you'll find the specific tweet that we would request that you would click like on. So however you decide to go forward with those 4 different options, we do appreciate. Just give a few shout outs here. Thank you to Financial News Now. Thank you to Teddy Lee. Thank you to Adrian and Sheila and SW and Brandon and Jeff and Jerry, Judy, Trunk, Margie, Andres, Ram, HR, and Tom and Violina, Claire, Richie, Sedona, Ed, Keola, Brian, Sonia, Paul, Ayakipa, Kishore, Dave, Roger, Evan, Kirk, Jim, Sudhir, and so many more. I can't get to all of you, but I do appreciate each and every one of you there. So thank you very much to all of you that help us along with that. And again, I'll make the same offer for you. If you click like for me and we get up and over 100, I'll plan on doing another full-length video for you when I'm scheduled to do the video next, which will be this upcoming Thursday. If we're under 100 likes, then I'll just plan on doing a quick little 15-minute version of the video that does not include a trade application example and only reviews the 4 major equity indices. So what it comes down to is your preference when it comes to that. Some of you may prefer a shortened version, and I can certainly understand that as well. It doesn't bother me in the least. It's less work for me if you guys prefer the shortened video. On the other hand, if you want the longer video, I don't mind doing that either. I don't mind putting in the effort as long as you guys are putting in the effort on your end to help support them. So we don't require you to pay us any money or anything like that. Just take 5 seconds out of your day to click like, and we really do appreciate that. Thank you so much. Let's also talk about the sector selector here. A reminder that the sector selector gets put together on Friday evenings, usually pretty late in the evening. This last Friday, I had a chance to take my son to an Imagine Dragons concert, so I actually had to get it done a little bit earlier than normal. We had a great time, by the way. Some of you might have seen my videos that I posted there on Twitter, but this last time I was able to get the sector selector done really early evening on Friday. But the point being, it is a couple of days stale by the time I review it with you guys here in this YouTube video on Tuesday afternoon. So this would not include any information that would be funneled into the numbers on Monday or Tuesday's trading, but still can give us a pretty good idea as far as any rotations that might be taking place and different things like that. So you can see that information technology did stay at the #1 position for the 3rd straight week now. And again, remember that does not include today, because although semiconductors would not have assisted in that effort today, but up until this week, the technology area had been one of the stronger areas out there. And as I mentioned before, it's a very broad and deep sector, and therefore you'll have lots of opportunities to find trades within that sector there as well. Now, the big news of the week in terms of week-over-week ranking changes was the huge drop-off in energy. Now, if that feels like deja vu, it's because we saw a very similar thing happen to energy here in the middle of June as well, when it was once #1 and then 4 or 5 weeks later found itself all the way dead last. Well, it was eventually able to recover a bit, and now we're seeing that big drop-off again. Now remember, most sectors aren't going to have the ability to make those dramatic movements on this graphic. Oil and gas stocks are a little bit like riding a bucking bronc. It's hard to stay on it for 8 seconds because the trends don't last all that long. That's what made earlier this year so unique, is that energy was actually a consistent trend. But otherwise, you do find that those types of stocks can move around with a lot of volatility, both on the upside and the downside. And so you're seeing that kind of reflected here in the sector selector. So with energy dropping off the map pretty considerably here, then that gave an opportunity for many of these other sectors to move up 1 or 2 positions. So I don't want to read too much into that, because I don't really think that any one of them seemed to stand out dramatically in my eye. It was more just that energy had struggled in comparison, and they all kind of had to be forced to be moved up more than anything else. Communications did remain dead last for the 2nd straight week. Remember, communications has struggled on a relative basis. Some of that as a result of what we saw with the Snapchat earnings result there a couple of weeks ago. But in addition to that, a lot of the media names, as I mentioned before, like Warner Brothers and some of those, just haven't been able to get their mojo going. So anyway, communications kind of sitting out this big rally that we've seen from a lot of these other areas. All right, let's go ahead and now pop back on over here to the main part of the platform. By the way, I taught my dividend growth investing class earlier today, and we did concentrate on the materials sector. So if you're interested in that, the recording is posted for those of you that are premium members of Market Scholars. And then David taught his directional option strategies class. So if you're trying to look for some interesting ways to take advantage of market movements through the options world, there's nobody better in the business than David, and I'm sure he'll get that recording posted if he hasn't done so already. So some good content to bring to your attention here earlier today on the premium level of Market Scholars. All right, so let's go ahead, and now that we're back over on the Thinkorswim platform, let's take a look here at our 12 grid analysis. Starting with chart 5A, this is our asset class 12 grid. And you can see it's actually a little bit odd to find only one red chart on this first set of 12 grids. Remember, these are a wide-ranging group of financial assets here, so it's rare to have anything close to a clean sweep. You usually have healthy doses of green and red on this first set of 12 grids. So right now we are more decidedly bullish on most financial assets, with the one exception being oil down there at the bottom. Oil did not close higher here today. It was down just a touch, down 0.12% if you were to use USO as your proxy. But you can see right here that it's been a struggle for oil in general over the last couple of months. Of course, we topped out back here back in the first week of June, where we were riding high, and then it really unwound in a hurry. So that was kind of going back to what I'd mentioned before about the energy sector itself. Remember, its fortunes are largely dictated by what's happening to the price of a barrel of oil. And when prices were zooming higher, energy stocks were zooming higher as well. Now that prices are falling, you're finding that those energy stocks are having a hard time stabilizing in that type of an environment. We'll see. Maybe they can get there yet again. But as of this moment, we do see a pretty negative trend there in oil from what we were witnessing earlier in 2022. You'll notice here that we've largely stayed below a falling 30-day moving average for the last month or so. That moving average has been red all the way since going back here the first week of July. And so that basically means price has been below a falling moving average, and the one or two times it's attempted to go up to the moving average, it's used it as resistance and sold off yet again. Whereas we had a little bit of a change of heart from gold, the commodity right next door to it here to the left. You'll notice that gold was also struggling earlier this year. In fact, gold was struggling a lot more earlier in the year than what we saw out of oil. So they've kind of changed roles from that perspective more recently. Anyway, after gold put in all of these oversold clusters here, we had about 5 or 6 of them in a row, as you can see, that first week of July. We finally did stabilize by going sideways for the next week, and then we've actually had a legitimate reversion to the mean type of a move here. And my expectation when we start that type of a move is that it would struggle once it gets close to the falling 30-day moving average. After all, that's what it had done several times back here. But this time around, it was a little different. It decided it had a little bit more strength than what was anticipated. And you can see that gold has moseyed its way a little bit higher here in the last week, at the same time that oil prices have largely been falling. So that's kind of interesting. Now, part of the reason behind it is because the US dollar has struggled in the last month. So notice that UUP has gone down over the last 1 month at the exact same time that gold has gone up. Remember, those two are oftentimes inversely correlated to one another, as the price of gold is priced in US dollars. So that certainly had a role, I have no doubt. Today the dollar was down 0.11%, gold was up 0.31%. What is a little bit strange about this is that they both have bullish postures. However, the US dollar is that light green color, telling us that we have a weakly bullish posture, whereas gold remains strongly bullish posture. So US dollar is kind of still sitting there at that level where you don't want to quite give up on it yet, because it's still sitting there right at that rising 30-day moving average. And you could envision it trying to, collect itself, so to speak, right here, and gather up some energy to push up and off of that moving average. It's taken its sweet old time to do it. It's been a week in the making, so we still don't have our answer as to whether it's going to be willing to do that or not. But remember, in general, I would venture to say that operating in the stock market is a little bit easier when the US dollar is weak. And so that's not lost on me either. Remember that the stock market itself had struggled for much of this year until the beginning of July. And for part of this move, since that rally started, it's partly because the US dollar has been weak. So in a way, we kind of want the US dollar to fail at this level, and it just refuses to do it. It's just riding that line higher right now. So that could definitely play a role on the future direction of the stock market as well. Let's talk about interest rates now. And you can see that the 10-year Treasury yield did advance here today and closed at about 2.8%, which is quite a bit higher than where it was just a week or so ago. I remember one of the days the 10-year Treasury yield was at around 2.52% at its lows. So it's advanced pretty nicely since then. And to no surprise, you'll see that we had some oversold cluster signals here just before this advance started on yields themselves. But the question is, where do we go from here? And with this moving average being red and us kind of nudging the head up underneath that falling moving average with the TNX here, the 10-year Treasury yield, there is that kind of speculation that Treasury yields may suffer at this moment But a lot of that will, of course, be dictated by what happens with inflation tomorrow, because if inflation is just off the handle hot tomorrow, then it's entirely possible we see yields follow in suit. And if they do, they'll have to rip right through that moving average right there. But right now, the assumption is that that won't happen, right? The assumption is that this new downtrend will hold until it doesn't. And when it doesn't, we'll find out, and we'll have to change our mindset around that. But right now, even though it's rallied for the last week, we remain below that falling 30-day moving average. And so the path of least resistance is still likely to the downside, or perhaps sideways, despite the light green background color here telling us that we have a weakly bullish posture. It's not strongly bullish. All the other 8 charts up above are strongly bullish. And as you can see from most of the charts, with the only exception being EEM, all of the other charts have green moving averages as well, telling us prices above rising moving averages, from everything from Bitcoin to preferred stocks to all of the bond categories and the foreign stocks. Financial assets have done quite a bit better here in the last month, and that is being now accounted for in that 30-day moving average. Today wasn't necessarily a glorious day for these entities. They were all largely on the downside, but because they have rallied so furiously in recent weeks, the posture is willing to be a bit forgiving around the point of having a day or two where the bears win the day. So none of the sell-offs were all that extreme or violent. I would say that Bitcoin falling 2% today was basically a non-event for a very volatile asset class like that. However, maybe a little bit more important was preferred stocks were down over 1% today. That is a little bit more of an aggressive move for a normally pretty quiet asset class like preferred stocks. So we'll keep our eye on that story. But remember, preferred stocks were awfully hot to the point where they were giving you overbought cluster signals here recently. So part of it might be just a little bit of profit taking that's taking place there as well. All right, let's go ahead and take a look at a sector breakdown here today in the United States. And as you can see, it's a pretty rosy picture out there, mostly green charts across the board. The only 2 exceptions right now are energy and healthcare. Energy, not as surprising given what we just saw on the sector selector tool, where they had a big drop off there. And so I'm not entirely surprised by that. Healthcare is a little bit more surprising because healthcare has been holding up reasonably well on the sector selector. But remember, there are some differences between that tool and this 12 grid here. One of the key differences is that the sector selector is going to be an equal weighted approach towards evaluating sector strength and weakness. This, what we're looking at here on the 12 grid, is a market cap weighted approach, because all of these XL ETFs, so like XLV and XLP and XLU and all that, those are basically put together to look at how the S&P 500 is formulated. And since it's a market cap weighted index on the broad level, then the fund family that controls these 11 ETFs here for the sectors kind of follows the same approach there. So in other words, stocks like Amazon and Tesla are going to have a much bigger impact on something like discretionary than something like Ralph Lauren or a smaller player out there like a GameStop or something like that. So anyway, with Amazon and Tesla struggling as much as they were today, no surprise that discretionary with XLY, the market cap weighted version of it, was the one that was down the worst amount out of these 11 different sectors today. It was down 1.59% today. On the plus side, it was energy that was up 1.76% there. And again, not entirely surprised to see that, because remember what I showed you there on the heat map, only one energy stock in the S&P 500 was in the red today. All the others were in the green. So nice little kind of reversal day there for energy. Really a reversal day for both of those, right? Discretionary was hot. Today was a reversal day to the downside. Energy was out of favor, and today was a reversal day to the upside. So the trends are what we care more about, not just what's happening on any one random day. And so far, the discretionary trend does look more healthy than what we see over here with energy. But healthcare, I would say, is kind of more of a sideways player at this moment in time from a market cap weighted perspective, even though on an equal weighted perspective, it does fare a little bit better. In terms of where some of the better looking charts are here at the moment, I would say that utilities have been rather impressive, and this is kind of an interesting reversal here because I remember looking at a lot of utilities charts right around this time period, kind of mid July time period, where it looked like a lot of utility stocks were rolling over, and you can see that even right here with XLU, why that would be the case. It just seems like this thing was grinding lower, 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 and you just didn't know if it was going to start falling off of a cliff all of a sudden. Well, that didn't end up happening. We had a nice reversal cut straight through that moving average, and utilities have really been building upon their strength, if anything, here over the last couple of weeks. And you can see that utilities from XLU's perspective is basically at 3-month highs. You're just barely shy of hitting a high that was established back here on May 27th, but you could eclipse that as soon as tomorrow. So I would say that utilities is now a very interesting trending category right alongside technology. Now, technology, as we know, was already number one on the sector selector, so no surprise there. But you can see that technology was well over its highs from what it established here back in June. Now, if you extend this further back, there will be other resistance points, but on this 3-month chart right here, we are basically still right around 3-month highs on technology and on utilities. Really, you could probably throw real estate into that conversation, and you could also throw industrials into that conversation as well as discretionary. So those are some of the key areas that seem to stand out from a trending perspective right now. The other sectors still have a little bit of work to do. So although their postures are largely bullish, they just don't have the strength that the other ones do, and they're still kind of trading in the middle of their 3-month range more than anything. All right, let's go ahead and get into our trade application example for the day. And for that, I'm going to come on over here to chart 3A. And as I had mentioned during the in the evaluation of the S&P 500 heat map, I was going to concentrate on a cable player here today. So let me explain. CHTR is the ticker symbol. This is Charter Communications. Some of you around the country may very well use them as your cable provider. I don't think I've ever lived in a place where they were my cable provider. I'm currently a Comcast fella, and I remember when I was out in San Diego, I think it was Cox Communication out there, so I'm not sure if Charter is more on the East Coast or where it is, but I do know it's a big player in the business, and so some of you no doubt use them as your provider. And, they are struggling a little bit here. As you can see, they were down 2.5% today. Remember that communications was the worst sector on the sector selector tool for the second straight week, so maybe that helps the bearish case in this case here as well. But you'll notice that on this chart, the background color went to light pink from this light blue here as of yesterday. And what that's signifying is a swing trading approach. This is the chart that we oftentimes use for my Wednesday morning factor-based swing trading class. And so we're concentrating our efforts more on the blue line on the market forecast as opposed to our traditional efforts on the green line. And from that perspective, you can see here that we've had kind of what we would identify as a long upper shadow yesterday that gave way to selling today, where we closed near the low of the session yesterday and today. So back to back, closing near the lows there. Now, yesterday it still closed in the green, so that's what made it kind of unique as well, because there was a gap up, tiny gap up to start the day, rallied furiously throughout the day, and then closed right down near the lows of the day. So still closed a touch higher than the prior day, but basically closed at its low for the day. So it didn't have a very healthy feel to it, even as recently as yesterday. But then today, it was much more obvious. We didn't have to argue about it. I think it was blindingly obvious here today that this was a stock that was under pressure, right? It woefully underperformed the market at large, with the S&P 500 being down only 0.42%. This one down 2.5% here today. And you'll notice that it is underperforming the S&P 500 over the last 3 months of this chart as well. There's this dotted gold line up above here that would show you, hey, had you invested in the S&P 500 or this individual stock at the start of this chart, where would you be today? And you'd be better off in the S&P 500 today, meaning that this one has been an underperformer. You'll notice that it did have its earnings announcement come out here, and they were already kind of in a free fall prior to that event, and then actually stabilized a couple of days after announcing that earnings, which resulted in this kind of 5-day rally or whatever it was right here. But because we had broken down below that moving average so violently before earnings, the big aggressive energy move that it had to respond to earnings may have very much worn itself out, because that was a big move there, right? This stock was trading at 421, and it traded as high yesterday as 477. So we're talking about $50 per share in 5 days' time. So that's probably going to exhaust a chart like this that didn't look all that healthy to begin with. Even before this most recent multi-week period, we were largely trending either down to sideways with this stock. Some of you may recall that I've actually done a trade application example on this company in the past where I just short sold it outright, and it actually was a pretty good performer for us. We made some pretty good money on that. I can't remember when it was. It was several months ago. But point being, today I opted to go a little bit of a different route. And I was still reminded of why I did the short selling idea when we did the prior trade all those months ago. And it's because the options market's not all that liquid for this one. But I was able to get it out there and get the trade filled in the end. Remember, one of the benefits that any of you who are premium members of Market Scholars has is that you'll see the trade alerts come through on our Telegram channel before everybody else that's watching the free video that night. So David and I do these trades that we will plan on presenting to you guys during the video while the stock market is still open. And so that way they're not recommendations or advice or anything like that, since we don't offer that. But it can at least give you another trade idea to consider before the market closes. And some of them will be winners, some of them will be losers. It's just the way that it works out. But we've had a pretty good string of success with a lot of our trades here recently. So we'll see if this one works for us as well. Remember, when we're in a market like this, I like to keep a little bit of balance in the portfolio. And so you've kind of been noticing that I've been adding to both bullish and bearish trades here recently. I haven't found this to be a market that is trending aggressively in one direction or another. Earlier this year it was aggressively trending lower, but since the beginning of July, there's been a little bit of a temperature change there where it kind of feels like there's a healthy balance between bulls and bears out there at this moment. And so I like to keep that kind of opportunity to have bearish and bullish trades in my portfolio. So tonight we decided, let's go ahead and do a bearish trade here. And what I did was what's known as a bear call spread. So I had mentioned before that I showed you guys how to do one of those on Amazon here recently. I think we also have one on JP Morgan right now. So there's been a few of these that I put on here in the last month or two. But this is another one where we did that. Now, compared to Amazon and JP Morgan, this one, as I mentioned before, is a lot less liquid. So you do have to kind of work your order maybe a little bit more than you would with the other two. Nonetheless, we were able to get more than a 30% return on risk when we placed the trade like we like to with these credit spreads. And the strikes that we selected in this case was the 480 strike to sell. And remember, this is a bear call spread. So we sold the 480 call and we bought the 490 call. This one does have $10 increments on its option chain. So for some of you, that might not be ideal. Obviously, I can't account for everybody who's watching the video. For some of you, it could work. For some of you, maybe it doesn't. It's just an idea, nothing more, nothing less. But the reason I was kind of interested in it is because of what I'd mentioned before, the big exhaustive move that it took to get back to the moving average, the long upper shadow that we saw yesterday, the underperformance versus the S&P 500 over the last 3 months, the closing basically near the lows of the last two candles, the transition of the posture on the near-term line from bullish to bearish. Not only that, but you can see that the moving average did get painted red here with today's move as well, which signifies price is now back below a falling 30-day moving average. And so what we want to accomplish with this trade is for this stock to stay below this blue line that you see up here. I think we got filled at $2.60 on that. So if you add $2.60 to the sold strike of 480, that's where you get that break even of 482.6. And so you can see that that does have kind of an interesting level of resistance as well, where you saw this area back here at the beginning of July use it as a resistance point. You also saw it use it as a touch point way back here on May 10th. And while you did break through here in the latter part of July, it didn't have a lot of traction beyond that point. So you could still kind of say that that's in the general vicinity of where sellers have emerged on this particular chart. So what we want out of this trade is for this stock to simply stay below that blue line on expiration day out there in the month of September. So it can go above the blue line before then, but as long as it falls back below it on expiration day in September, we'd be good to go. But ideally, what you want to give yourself more breathing room is for the stock to immediately become bearish on you or sideways and not even threaten that blue line. That helps you feel more confident in your trade through the life of the trade. So that's what we're hoping for in this case, is continued weakness within some of those communication stocks, in this case, Charter Communications. Okay, so that's what I had for you here tonight. I hope you got value out of the presentation. If you did, I have one simple request from you. Just simply click like for me there on Twitter. As long as we're up and over 100 likes, by the time I'm scheduled to do this on Thursday afternoon, I'll plan on doing another full-length video, including a trade application example like this one here. If we're under 100 likes, then we'll just plan on sticking with a very short 15-minute version of only reviewing the market indices. So I'll let you guys decide collectively on that, but I do appreciate you checking out this video nonetheless, and I wish you all the best of success with your trades and your investments moving forward. Take care, everybody. Bye-bye.